There is a moment somewhere between the peak of a bull market and the beginning of a devastating fall when the architects of the financial world quietly begin moving their pieces off the board. It does not happen with press conferences or public announcements. It does not come with a headline that says the tide is turning. It happens in the language of portfolio rebalancing, in the slow accumulation of cash, in the subtle rotation away from momentum and towards safety. By the time the average investor notices, the migration of capital has already happened. The question that every serious investor in the United States, Canada, the United Kingdom, Europe, and indeed Russia must now ask themselves is not whether the smart money has been moving. The data is unambiguous on that point. The real question is whether you have been paying attention and whether it is already too late to act responsibly. To understand where we are today, we must first understand the architecture of the current moment. The S&P 500 closed the year 2025 with a gain of approximately 17.9%, its third consecutive year of double-digit returns. The cumulative gain across those 3 years was roughly 78%, a pace of appreciation that history tells us is exceptional and, more importantly, historically unsustainable. The Nasdaq followed a similarly aggressive trajectory. This is not the language of a healthy, measured bull market quietly reflecting economic fundamentals. This is the language of a market that has been running far ahead of the underlying economy, fueled by a narrow concentration of mega-cap technology stocks that have come to represent an extraordinary proportion of the entire index. To understand the depth of that concentration, consider this single data point. The Magnificent Seven, a group consisting of Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla, now represent approximately 34.3% of the entire S&P 500 as of February 2026. A decade ago, in 2016, those same companies represented only 12.5% of the index. Their average total return in 2025 accounted for approximately 40% of the index's entire performance. What this means in plain language is that if you owned a broad S&P 500 index fund in 2025, nearly half of your gains came from a basket of just 7 companies. That is not diversification. That is concentration risk wearing the mask of diversification, and it is one of the most dangerous structural conditions a market can find itself in. Now layer over that concentration the question of valuation. As of December 2025, the United States Shiller cyclically adjusted price-to-earnings ratio, commonly known as the CAPE ratio, stood at approximately 39.68. This is a ratio that compares stock prices to an inflation-adjusted average of earnings over the prior 10 years, smoothing out the volatility of any single economic cycle. A reading of 39.68 is the highest this measure has been in approximately 25 years, eclipsing even the valuations seen heading into the 2008 financial crisis, and approaching but not yet matching the extreme levels seen at the peak of the dot-com bubble in 2000. The long-term average of the CAPE ratio across a full century of American market history is approximately 17. To put it in perspective, the current reading is more than twice that historical average. This does not mean a crash is imminent tomorrow. What it does mean is that the margin of safety embedded in current equity prices is extraordinarily thin, and the probability of delivering historically normal forward returns from today's prices is very low. The Buffett Indicator tells a similarly alarming story. This measure, which compares the total market capitalization of all publicly traded United States equities to the country's gross domestic product, recently crossed the threshold of 200%. As of September 2025, the total United States stock market value stood at approximately $70.68 trillion against an annualized GDP of around $30.77 trillion. Warren Buffett himself, who first publicized this ratio as a meaningful valuation tool in a famous 2001 Fortune magazine article, has described readings significantly above 100% as playing with fire. At 200%, the measure is far beyond anything that has historically been justified by economic fundamentals alone. And this is where the man himself becomes the most powerful piece of evidence. Warren Buffett's Berkshire Hathaway, as of Q3 2025, held a record $381.7 billion in cash and short-term investments, representing over 31% of the company's total assets. To fully appreciate what that number means, Understand that Berkshire accumulated the biggest quarterly jump in its cash position in the company's history during that quarter alone, moving from $344 billion to $381.7 billion between June and September of 2025. Over the same period, Berkshire sold $12.5 billion in stock and bought only $6.4 billion, marking the 12th consecutive quarter in which Buffett was a net seller of equities. 12 consecutive quarters. That is 3 full years of an investor whose entire philosophy is built around buying and holding great businesses at fair prices, quietly and consistently choosing to exit rather than accumulate. Buffett does not panic. Buffett does not chase trends. When Buffett accumulates cash at this pace, it is not because he has run out of ideas. It is because the price of the ideas available to him is not one he can justify paying. That is arguably the single most important signal a retail investor can receive. But the smart money is not a single person, and its movements are not confined to one portfolio. Across the institutional landscape in late 2025 and early 2026, a pattern of quiet repositioning has been underway. According to Reuters, hedge funds have been trimming their North American equity exposure amid rising trade tensions, a weakening dollar narrative, and concerns about megacap valuations. A net 23% of allocators added to North America-focused fund strategies in 2025, down significantly from the 39% who allocated to the same strategies in 2024. The direction of travel is clear. Capital that was enthusiastically pouring into American equities is now being more cautiously deployed and in many cases redirected toward alternative assets, emerging markets, and defensive instruments. The backdrop against which all of this is occurring is equally important to understand. J.P. Morgan Global Research, one of the world's most respected and data-intensive financial institutions, assigned a 35% probability of a United States and global recession in 2026 as of its December 2025 market outlook. At various points during 2025, that figure climbed as high as 60%, following the initial shock of sweeping trade tariff announcements, before moderating after partial trade truces. The New York Federal Reserve's own recession probability model, as of January 2026, showed a 20.4% chance of recession by December 2026. These are not fringe forecasts from perma-bear bloggers looking for attention. These are the considered probabilistic assessments of the most analytically sophisticated financial institutions in the world. The fiscal backdrop reinforces the concern. According to the Congressional Budget Office's February 2026 Budget and Economic Outlook, the federal budget deficit for fiscal year 2026 is projected at $1.9 trillion. United States federal debt as of February 12, 2026, stood at $38.65 trillion. Interest costs on that debt, as a share of GDP, rose to a record 3.2% of GDP in 2025 and are projected to climb to 4.6% by 2036. Fortune magazine reported in February 2026 that a United States debt spiral could begin soon as the interest rate on government borrowing is poised to exceed the rate of economic growth, a threshold that historically marks a point of fiscal instability. When the cost of servicing debt grows faster than the economy that is supposed to generate the tax revenue to pay for it, the options available to policymakers narrow rapidly, and the consequences eventually find their way into asset prices. The Federal Reserve's position adds another layer of complexity. After cutting the federal funds rate by 75 basis points in the second half of 2025, bringing it to a target range of approximately 3.5 to 3.75% as of January 2026, the Fed found itself navigating between the risk of rekindling inflation and the need to support growth. Inflation, as measured by the Consumer Price Index, slowed to an estimated 2.5% in January 2026, down from 2.7% in each of the prior 2 months. That is progress, but the Fed's 2% target remains unachieved, and the stickiness of inflation in services and housing has constrained the central bank's ability to cut aggressively, leaving financial conditions tighter than many borrowers had hoped. Now let us turn to the historical record, because this is where the emotional discipline of investing meets the cold mathematics of probability. The stock market crash of 1929 was preceded by a period of euphoric retail participation, rising leverage, narrow market concentration, and extreme valuations. The Dow Jones Industrial Average lost approximately 89% of its value from peak to trough, and the index did not return to its pre-crash levels until November 1954, 25 years later. The dot-com crash of 2000 saw the Nasdaq lose roughly 78% of its value over approximately 30 months, wiping out trillions of dollars in paper wealth and destroying thousands of companies that had been valued on the basis of future promises rather than present earnings. The financial crisis of 2008 cut the S&P 500 by approximately 50% in just 16 months. The COVID-19 crash of March 2020 was the sharpest 30-day collapse in market history, though the recovery in that instance was equally dramatic given the extraordinary monetary response. In each of these episodes, the common thread was not the event itself, but the conditions that existed before the event. Extreme valuations, excessive leverage, concentrated bets in a narrow set of themes, institutional investors quietly reducing risk before the public recognized the danger. These are patterns, not coincidences, and they are patterns that a careful reading of the current environment reveals with uncomfortable clarity. So what does all of this mean for someone sitting in New York or London, Toronto, or Frankfurt trying to make rational decisions about their financial future? It does not mean you should liquidate everything tomorrow, move to cash, and wait for the world to end. Timing the market precisely is a trap that has destroyed more wealth than it has protected. Every person who exited the market in April 2025 following the tariff-related sell-off, expecting the worst, watched the market recover and push higher. The cost of being wrong about timing is not just the losses you avoid, but the gains you miss while you wait. Historically, missing the best 10 trading days in any given decade can reduce your total returns by more than half. That is the brutal mathematics of market timing, and it is why even the smartest institutional investors rarely make all or nothing calls. What the smart money actually does, and what the evidence consistently shows in the 13F filings, the quarterly earnings reports, and the institutional allocation surveys, is make deliberate, incremental, risk-adjusted repositioning moves. They do not exit entirely. They rotate, they hedge. They increase their allocation to assets that historically preserve capital or appreciate during periods of equity market stress. Here's how that translates into concrete, implementable strategy for the individual investor. The first and most fundamental step is to honestly assess your current asset allocation against your actual risk tolerance and time horizon. After 3 years of 78% cumulative gains in equities, most portfolios that were not rebalanced are now carrying substantially more equity exposure than their original target weight. A portfolio that was designed to be 60% equities and 40% bonds at the beginning of 2023 may now be 75% equities and 25% bonds simply due to price appreciation, without a single additional dollar being invested. That drift is not a strategy. Rebalancing back toward your target weight is one of the simplest, most evidence-based risk management practices available, and it essentially forces you to take profits at high prices and redeploy capital toward assets that have relatively underperformed. The second step involves examining the quality and concentration of your equity holdings. If you own a broad index fund, you are carrying approximately 34% exposure to 7 companies. That is a fact worth knowing and reflecting on. Many sophisticated investors are now choosing to complement their broad index exposure with allocations to equally weighted index funds, small cap value funds, or international equity funds that trade at far more modest valuations. As of early 2026, the United States CAPE ratio of nearly 40 stands in stark contrast to the comparable ratios of most other developed market countries, several of which trade in the range of 15 to 20, closer to their long-term historical norms. International diversification is not just a geographic concept. It is, at current valuations, a fundamental valuation arbitrage opportunity. The third step is understanding the role of defensive assets in a portfolio that may be entering a more volatile period. Gold is perhaps the most instructive example. In the first half of 2025, gold demonstrated a meaningful decoupling from its traditional negative correlation with risk assets, rising even as equity markets were uncertain, and as doubts about the long-term reliability of the United States dollar as a reserve currency were gaining traction. Gold has outperformed bonds in real terms since the end of the gold standard, according to WisdomTree data published in January 2026. Its role is no longer simply that of an inflation hedge. Increasingly, institutional allocators are treating it as a hedge against what they describe as institutional doubt, a concern that the credibility and fiscal sustainability of major governments may be more uncertain than the current benign pricing of sovereign bonds implies. An allocation of between 5 and 10% in gold via physical holdings, gold ETFs, or gold mining equities is a measured and historically justified defensive position in an environment characterized by elevated valuations, fiscal stress, and geopolitical uncertainty. Treasury bonds represent a more nuanced consideration. In a conventional recessionary scenario, long-duration government bonds typically appreciate as investors seek safety and as the Federal Reserve cuts rates aggressively to stimulate the economy. However, in an environment where inflation remains sticky and fiscal sustainability is questioned, the relationship between recession risk and bond performance is less reliable than it has historically been. Short-term Treasury bills, which currently yield in the range of 4 to 4.5%, offer an attractive risk-adjusted return relative to the expected forward returns of equities priced at a CAPE ratio of nearly 40. Extending your emergency fund or your short-term capital preservation position into Treasury bills or short-duration bond funds is not a heroic act of market timing. It is a rational response to a mathematical reality that says the compensation you are receiving for taking equity risk is unusually low relative to the alternative. The fourth step, and one that is consistently overlooked by retail investors who are focused on the drama of prediction, is the maintenance of a genuine cash reserve, not as a permanent strategy, but as dry powder, the capacity to deploy capital during periods of market dislocation when prices have corrected and expected forward returns are significantly higher. The investors who made generational wealth in 2008 and 2009 were not the ones who predicted the crash. They were the ones who still had capital available to deploy when quality assets were selling at deeply discounted prices. Berkshire Hathaway's extraordinary long-term performance is partly explained by its perpetual maintenance of exactly this kind of strategic liquidity. Having 10 to 20% of your investable assets in cash or near-cash equivalents is not a sign of fear. In the current environment, it is arguably a sign of sophisticated preparation. Now let us address the risk management dimension explicitly, because this is where the intellectual honesty of investing comes under the greatest strain. Risk management begins with acknowledging that you cannot know when a correction or crash will occur, even if the conditions that historically precede such events are clearly present. The CAPE ratio has been elevated above its historical average for nearly the entire post-2009 bull market. Someone who exited equities in 2012 because the CAPE ratio looked stretched would have missed more than a decade of returns. Valuations are a terrible short-term timing tool and a reasonably good long-term return predictor. What the data tells us is not that a crash is coming next month, but that the expected annualized returns of United States equities over the next 7 to 10 years from current valuation levels are likely to be meaningfully lower than the returns of the past decade. Research by Robert Shiller and others has consistently shown that starting from a CAPE ratio above 30, 10-year forward real returns have typically been in the low to mid-single-digit range, not the double-digit annual returns that the recent past might lead investors to expect. Understanding this distinction is crucial for anyone making financial plans, whether that means deciding how aggressively to pay down debt versus invest, how much to save for retirement, or when to shift from accumulation to decumulation. If your financial plan assumes 10 to 12% annual equity returns indefinitely because that is what the last decade has delivered, and the evidence suggests that the next decade from current valuations is more likely to deliver 4 to 6% annually, then your retirement projections may be built on an unreliable foundation. The responsible response is not panic, but recalibration, perhaps saving a higher percentage of income, extending your working years modestly, or reducing projected spending in retirement. Legal, tax, and regulatory considerations also deserve attention in this context, because the mechanics of repositioning a portfolio have real financial consequences that vary meaningfully by jurisdiction. In the United States, selling appreciated securities in a taxable brokerage account triggers capital gains taxes, either at the short-term rate, which applies to assets held for less than 1 year and can be as high as 37% for high earners at the federal level, or at the long-term rate, which ranges from 0 to 20% depending on income, plus a potential 3.8% net investment income tax. Before making any significant repositioning decision in a taxable account, a conversation with a qualified tax advisor is not optional. It is necessary. The after-tax return of any strategy must be the relevant metric. In the United Kingdom, investors benefit from an annual capital gains tax allowance of £3,000 as of the 2024 to 2025 tax year, but gains above that threshold are taxed at rates that have risen significantly following recent budget changes, making the sequencing of portfolio changes meaningful. In Canada, 50% of capital gains are included in taxable income, while in Germany and other European Union jurisdictions, capital gains on investments held outside of tax-advantaged accounts are generally subject to a 25% withholding tax plus solidarity surcharge. In all of these cases, using available tax-advantaged accounts, whether that is a 401k or IRA in the United States, an RRSP or TFSA in Canada, an ISA in the United Kingdom, or pension wrappers in European jurisdictions, to execute rebalancing decisions is the most efficient mechanism available. Realistic return expectations deserve direct and honest treatment here. The narrative of the past decade has been so dominated by extraordinary equity gains that many investors, particularly those who began investing after 2010, have no lived experience of a prolonged bear market. They have experienced the sharp drops of 2018, early 2020, and 2022, but in each case, recovery came within months to a few years. History is much more diverse than that sample suggests. Japan's Nikkei 225 index peaked in December 1989 and did not recover to that level for approximately 34 years. The Nasdaq 100 took approximately 15 years to recover from its 2000 peak. An investor who retired in 2000 into an all-equity portfolio and began withdrawing to fund living expenses would have experienced severe and potentially irreversible damage to their portfolio before the market recovered. Sequence of returns risk is real, it is asymmetric, and it disproportionately affects people in the 5 years before and the 5 years after retirement, a window during which large drawdowns can permanently impair the portfolio's capacity to sustain withdrawals. None of this analysis should generate paralysis. It should generate informed action taken with discipline, proportion, and clarity of purpose. The investors who will look back on this period having made good decisions are not those who predicted the timing of the next correction with eerie accuracy. They are those who methodically reduced concentration risk, increased portfolio resilience, maintained liquidity, and positioned themselves to participate in the recovery that will inevitably follow whatever turbulence lies ahead. Markets have recovered from every single crash in history. The question is not whether recovery will come, but whether you will still have capital invested when it does, and whether your financial plan can withstand the journey. The geopolitical dimension of the current environment adds a layer of complexity that does not fit neatly into any single valuation model, but is too important to ignore. The re-escalation of trade tensions through tariff policies, the ongoing restructuring of global supply chains, the energy transition, the AI investment cycle, and its implications for capital expenditure and corporate earnings, the trajectory of European defense spending following shifts in NATO dynamics, and the position of the Russian economy amid continued sanctions and commodity market adjustments, all of these are forces that are reshaping the global allocation of capital in ways that have no clear historical precedent. For investors in the United Kingdom and Europe, the divergence between United States equity valuations and domestic market valuations has created a situation where European equities, trading at CAPE ratios roughly half those of the United States, offer a more conventional margin of safety while also providing natural currency diversification. For Russian investors navigating capital controls and limited access to international markets, the focus on domestic assets, commodities, and precious metals as stores of value remains the most practically available form of wealth preservation in the current environment. Morgan Stanley's January 2026 market outlook captured the present mood with surgical precision. Wall Street's optimism remains sky high, they wrote, but with expectations stretched and political risks looming, the market may be walking a tightrope. That is not the language of doom. It is the language of calibrated caution from an institution whose analysts spend their careers measuring risk for a living. The most important insight that separates investors who build durable wealth from those who merely ride a cycle is the recognition that markets are not simply rising or falling machines. They are complex, reflexive systems where the behavior of participants shapes the outcome, where psychology amplifies both gains and losses, and where the gap between price and value eventually, always, and without exception, closes. Sometimes that closing happens through earnings growing into elevated valuations. Sometimes it happens through prices falling to meet more modest earnings. We cannot know which mechanism will dominate in the period ahead, but we can know that the current gap between price and fundamental value, as measured by multiple independent methodologies, each pointing in the same direction, is among the widest in modern market history. When the architect of one of the most successful investment records in human history has been a net seller of equities for 12 consecutive quarters and has accumulated a cash position representing 31% of his conglomerate's assets, it is worth asking what he knows that the crowd does not. The answer is probably that he knows nothing that is not already visible in the public data. What he does that most investors do not is act on what the data tells him, without being distracted by the noise of daily price movements, the excitement of new narratives, or the social pressure of watching peers profit from positions he has already decided are overpriced. That discipline, that capacity to see clearly and act proportionally, is not a gift reserved for billionaires. It is a practice available to every person willing to engage with the evidence seriously and to manage their own financial affairs with the same rigor they would apply to any other important decision in their lives. The warning signs are present. The valuation metrics are stretched by virtually every measure available. The smart money has been methodically repositioning for 2 to 3 years. The macroeconomic environment carries meaningful recession risk acknowledged by the most credible institutions in global finance. The fiscal trajectory of the world's largest economy is moving in a direction that raises structural concerns about long-term financial stability. None of this tells you what price the S&P 500 will be on any given day, next month or next year, but all of it tells you something deeply important about the risk-reward relationship of the current investment environment, and about the kind of portfolio that is likely to survive and ultimately thrive across whatever comes next. The investors who are never too late are not the ones who got in or out at the perfect moment. They are the ones who understood what they owned, why they owned it, and what they would do under a range of different scenarios before those scenarios arrived. Build that understanding now, reduce unnecessary concentration risk now, maintain liquidity now, and above all, resist the most dangerous assumption in investing, the belief that because prices have risen for 3 consecutive years, they must continue rising indefinitely. They never have. And there is no fundamental reason in this particular market, at these particular valuations, to believe that this time will be the exception.